Hi there, welcome to Kneppy Invest. One of my favorite spaces to invest in is in small cap companies. And when I say small cap, I don't mean the expert definition of small cap. In fact, if you go to, say, the BlackRock iShares ASX Small Ordinaries ETF, have a look at the constituents of that particular small cap ETF, and you'll see some companies that you might consider bigger cap, maybe medium cap, maybe not big cap, but definitely medium cap. For instance, I actually have Promedicus in there. I'm not sure about that. Viva Energy, Flight Center, Champion Iron, Sandfire Resources, CSR, Perpetual Limited, Hub24, TEDx Pharmaceuticals, which now has a market cap about $3 billion, AUB Group, Webjet, Premier Investments, ARB Corporation, Ventia Services, Perseus Mining, Harvey Norman, Breville Group, Corporate Travel Management. I wonder how old this is. This says as of 12th of December 2023. I'm just going through all their holdings. Brickworks is in there as well. I don't define those companies as small cap companies. How I define small cap companies is anything below a few $100 million. So if a company has a market cap of, say, $600 million, in my opinion, that's not small cap. That's a pretty big company. In fact, if I was a founder of a company that grew to $600 million, I would be not thinking that is small at all. So typically when I talk about small cap companies, these companies will have a market cap more than usual below $100 million. A few of them, in fact, one of the companies I'll be featuring in today's video does have a market cap of about $150, $150 million, not $150. I could buy that company outright right now. And the reason I like these sort of companies is because of the potential returns you can get. Now, there's also an increased risk, but a lot of times many investors ignore the potential returns and just focus on the risk. And a perfect example of this, or the potential returns you can get from investing in small cap companies, is Promedicas. And I'll look and show you how much Promedicus has grown over the past 10 years. So in this video today, I am going to show you two small cap companies that are potential buys. Now, I don't own either of these companies, and more than likely, particularly one of these companies, I won't own until the company shows me signs, or even the market shows me signs that they're willing to pay a little bit more for that company. But still, it looks fairly cheap at today's prices. So before we have a look at these two small cap companies, let's have a look at the history of Promedicus. And let's go back to 2013, just to see how much Promedicus was valued back then. So this is the Promedicus chart back in 2013. This would have been towards the end of 2013. And if you look at this 10-year period here, now you probably wouldn't be that excited. In fact, back in 2006, the share price of Promedicus got as high as $1.75, and it was as low as 20 cents back in 2011. So even though we hear the name Promedicus and we think it's been a success story on the ASX, there was a period of time that this company was underloved, underappreciated potentially. And in 2013, this company had $11 million of revenue, so not a lot of revenue, and only had a market cap of $42 million. And around about 2013 and 14 is when I started paying attention to Promedicus. I never took a position in this company, but I still started following the fortunes. And then the share price just went on a massive run, and it's still on a massive run right now. So let's see how much this company has grown over the past 10 years, just to show you the potential you can achieve if you have the conviction and are able to tolerate the risk of buying in these really small cap companies. And this is the updated Promedicus chart going back to the middle of 2013. You can see that between about 2013 and 2018, you can't really see the increase in share price because, as you can definitely see by this chart, it's been an uptrend ever since then. This is a beautiful looking uptrend. Whenever the share price tips back, like it did back in 2020 during the COVID-19 financial panic, and also during the middle of 2022, that's the time to think about taking position in this company. And for full disclosure purposes, I am a shareholder of Promedicus. Everyone says it's just too expensive for me to take a position in, and yet the share price keeps on climbing. So right now, as I speak, on December 14, 2023, this company has a market cap of $9.8 billion with revenue of only 125 million. So revenue has increased a fair bit from 2013. So it's increased by tenfold. Yet the market cap of this company has increased from 40 odd million to $9.8 billion. There are some investors out there who have seen their returns increase 100-fold, or it has been a 100 bagger for them. Yes, a 100 bagger example on the ASX. You can't get these sort of returns by investing in Commonwealth Bank, Telstra. In fact, if you invest in some of these companies, your returns over a 10-year period actually might go backwards. Woolworths, even CSL, you can't get these sort of returns. But in small cap land, you definitely can get these returns. That's why I'm fascinated by this space. And that's why, even though some of the companies I invest in this area, this sector, they're not successful in the long run, sometimes I will invest in these sort of companies. Now, not all companies are going to give you returns that Predicas has achieved, but it's just the potential you might get if you find the right company in this space. And even right now, two of the companies I own in my small cap portfolio since the start of the financial year are up over 100%. One of those companies is almost up 200%. That's the sort of returns if you are able to choose right. So in this video series, this is the third video I've done in this series. The other four companies I've profiled include Veeam, LaserBond, Stealth Global, and LaserBond, Veeam, Stealth Global, and Visan. Now, if I remember, the four of those companies have all performed fairly well over the past 6 or so months. And I'm not saying these two companies will perform like those other four companies. I'm not saying these two companies will perform like Predicas. In fact, I can almost guarantee you, particularly one of these companies won't perform like Predicas simply because of the space and sector they're in. But the whole point of me doing this video series, is to share ideas with you. Just because one of these companies may not be the company for me doesn't mean it can't be the company for you. Sometimes we make mistakes, and possibly by me not investing in one of these companies, it may be a mistake moving forward, a mistake that I could learn from. So let's get into it. And the first company I want to profile in today's video is a company called Cosol. Now, Cosol is a global provider of end-to-end asset management solutions that enable asset-intensive organizations to get the best from their people, process, systems, and data. This is exactly what Cosol does. Now, this is way too complicated than I'd like to see. I like easy to understand businesses. So the first thing I want to know is, what is asset management? Because this is an asset management software company. In fact, I've heard some people describe Cosol as an asset management as a service company, so AMAAS. So sort of like a software as a service company, but a little bit more in that niche area. So asset management is just a systematic approach to optimizing the entire life cycle of an organization's physical assets, from initial acquisition, maintenance, utilization, and eventual disposal. So hopefully that makes sense, because I'm not going to go through this whole diagram. Some of the clients they do have are quite impressive. We're talking about Rio Tinto, Newmont, Energy Queensland, Downer, Horizon, Australia Government, and also the Queensland Government, primarily in Australia, but they do have revenue from overseas, particularly in North America. It's currently listed on the ASX in late January 2020, so that's pretty bad timing, just before COVID-19. However, the share price is up since then. And now let's have a look at some of, actually, before we have a look at the financials, this company has been a little bit acquisitive over the past, say, 3 years. They've made 4 acquisitions since listing, but this company also has some nice organic growth. So revenue per share has grown really nicely over the past 3 or 4 years. And I've already mentioned that the majority of the revenue comes from Australia. So 84% of the revenue comes from Asia Pacific and 16% comes from North America. Now let's have a look at the financial year 23 revenue, or not revenue, financial year 23 financial results for this company. Revenue of $75.1 million, up nicely from the previous year, 55.7% growth. Profit of $8 million, up 44.3%. So really nice growth there. There was some growth because of acquisitions. Now, gross margin, I was a little bit surprised by how low gross margins were. 35.7%, because this is a software company, asset management as a service. And with such low gross margins, I'm wondering if the company is way more complex than just a software company, because typically software companies have really high gross margins. So I'm going to pay a little bit more attention, do a little bit more research on Cosol, because a lot of the other stuff I do or have researched about in regards to this company do look quite impressive. So gross margins is probably the main red flag I have on this company. Probably the other secondary red flags are their operating cash flow and free cash flow, only between $4 and $5 million. I would prefer that to be a little bit higher than they are, but return on equity really nice at 18.7. In fact, the return on equity of this company has been between 18 and 20 since they listed on the ASX. They also have net debt of $9.9 million, a 3% dividend yield. I think it's just below 3% right now. And they also have a free cash flow yield of only 2.2%. So I would prefer that to be a little bit higher. So the main things I'm looking for or looking at in return in regards to this company is that gross margins. If this company can start to increase their gross margins and maintain increasing their revenue, profit, also their cash flow, this could be a really interesting play on the ASX. And I should also mention, I'd like to see that return on equity remain between 18 and 20. Now, this is their 4-year history going back to financial year 20, because this company has only been listed on the ASX since that time. And really nice growth, really impressive growth. And this is one of the first things I look at is if a company is growing revenue. Now, ideally, I like to look at revenue per share growth. But revenue per share growth, even though this company has made some acquisitions, has been growing over the past 4 years. But revenue has grown from 11.7 million to 75.1 million, EBITDA from 2.1 to 11.6 million, profit after tax 1.5 to 8 million, and earnings per share from 2.1 to 5.4 million. So you can see, or sets, I mean, so you can see that the earnings per share CAGR is at 26.8%, which is significantly lower than revenue, EBITDA, and profit after tax CAGR. The main reason behind that is because shares on issue have increased over the past 4 years. So if shares on issue have increased over a period of time, you expect that anything that you look at in regards to per share, so revenue per share, EBITDA per share, profit per share, which is earnings per share, should have not increased as much as the underlying numbers, so revenue, EBITDA, and profit, because there's more shares on issue. So hopefully that makes sense. But still, earnings per share growing at 26.8% per year is quite impressive. I'd like to see that continue moving forward. But 5.4 earnings per share right now for a company with a share price less than $1, there could be some value here. Now, is there value? Well, that's up to you to decide, but I'm just saying there might be some value here, particularly if they maintain these growth numbers moving forward. Now let's have a look at the chart for Cosol. So share price 89 cents, and I just grabbed the share price recently. I'm recording this video at 1 p.m. on December 14, so share price is probably hovering around that level because really, if you look at the past year or so, share price has done nothing much, going sideways. Shares on issue 175 million. That's up maybe 15 to 20% since they listed. Market cap of the company 156 million, which means the PE ratio is around 19. If this company had a PE ratio towards 10, I would be really interested in taking position in this company. So possibly in the middle of 2022, when the share price got down to 45 cents or so, that would have been a really good time to take a position in this company. Unfortunately, I was not following Cosol all that closely back then. So I'm excited to have done a little bit of research on this company, because if they can maintain the growth they have experienced over the last 4 years, even a PE ratio of 19 might actually be cheap for this type of growth, particularly if they can increase that gross margins. That's the main thing I'll be focusing on the next few years in regards to Cosol. Can they increase their gross margins to look more like a software company? Second company I want to talk about is, I probably have less enthusiasm about this company than I do Cosol, and that's Dynamic Group Holdings. I, in fact, actually owned this company one point in time when they were known as Dynamic Drill and Blast. They did make a few acquisitions, definitely one acquisition of Orlando Drilling. They've also got another subsidiary called Well Drill. So you can just see by the name what this company does. Well, hopefully you can. Dynamic Drill and Blast. So during the last financial year, this company's primary activities consisted of mine production, drill and blast, construction, drill and blast, vibration sensitive drill and blast, I have no idea what that means, exploration drilling, grade control drilling, production supply and injection wells, deep artesian and geothermal wells, mine service holes, and pump test services. So you can definitely see that this company is a mining services company. And you might expect, with there being sort of a mining boom happening right now, sort of a mini mining boom, a lot of companies are doing exploring, that mining services companies should be doing fairly well right now. Well, that's not true for Dynamic Group Holdings. And you'll be able to see that when we look at the chart in a few minutes' time. But first, let's have a look at the financial year 23 results for this company. Now, when I took a look at the results for this company, I could see an argument that suggests that this company is dirt cheap right now. Now, there's another company, another drill company on the ASX called Mitchell Services. That is another company that looks dirt cheap right now. But the market is just not interested in either of these companies. There's quite a few drill companies on the ASX. This used to be called Ausdrill, that became Parenti, and then Parenti recently acquired DDH1 drill or something like that. So there are quite a few drill companies on the ASX, but my focus today is Dynamic, what used to be called Dynamic Drill and Blast, now Dynamic Group Holdings. Revenue of 103 million, up 40.8%. Profit of only 2 million. So this company exists on fairly low margins. In fact, even though their revenue increased 40%, profit is actually down from last year. But then compare the profit to operating cash flow and free cash flow. Operating cash flow 16.9 million, free cash flow 8.5 million. So the first thing I want to figure out when it comes to this company is why such a big discrepancy between profit and operating cash flow and free cash flow. And more than likely, the main reason behind that is because of capital expenditure. You'd think because this company does drill and blasting, they are a capital intensive company. And we'll look at that in a second. The way you look at that is just look at the way I looked at it or found that out is just by looking at the cash flow and profit reconciliation, which was in the notes, and look at depreciation, amortization, that sort of thing. Anyway, return on equity 4.2. I do like return on equity well above 10. So that sort of return on equity is well below what I want to see. And I never would consider this company to be a high quality company. So most high quality companies, if not all high quality companies, would have a return on equity well above 10. Another red flag I found in regards to Dynamic Group Holdings is net debt. They have $18.9 million of net debt. And I do prefer any company, particularly a small cap company like Dynamic Drill, to have at least net cash, not net debt of $18.9 million. So let's have a look at note 36, which is the reconciliation of profit after income tax to net cash. I just wanted to see why there was a big difference between profit and the operating cash flow. There was a massive difference, 2 million compared to almost 17 million. And the main adjustment is depreciation amortization, 14.6 million, which straight away tells us that this company is capital intensive company. They will spend some years fair bit of money on capital expenditure, which is property, plant and equipment. The other thing that could have led to a significant difference between profit and operating cash flow could be just changes in working capital. So we're talking about trade and other receivables, payables, inventories, that sort of thing. And that's in the bottom half of this particular note. And to be fair with you, not much changes in working capital, a slight change in working capital. So there was an increase in trade and other receivables, but also an increase in trade and other payables. And they almost offset a slight increase in inventories. But overall, the main reason there's a big difference between profit and operating cash flow for this company is because of depreciation, amortization, because this company is a capital intensive company, which makes sense because they have drills. And I would imagine mining, drilling things, equipment costs a fair bit of money, and they can be worn out fairly quickly, and they have to maintain it and do stuff like that. and probably buy more drill and blasting equipment quite often as well. So I've already mentioned that the market doesn't like this company at all right now. In fact, the market hasn't liked this company ever since or just after they listed on the ASX. Now, just after they listed back in August, in fact, I should say they listed in August 2020. So both these companies listed in 2020, which is not unusual because a plethora of companies listed in 2020 and 2021. Anyway, just after they listed, there was a nice little rally in the share price around September, October 2020. But since the high in the company's share price in October 2020, share price has fallen and has moved into a well-defined downtrend. Share price keeps on falling. No, not much volume either. So the market is just not interested in this company. And when the market is not interested in the company, typically the share price just drifts lower and lower and lower. So what I'm waiting for here is a bit of an increase in volume, which is telling me the market thinks this company is becoming good value or attractively valued. It hasn't got there quite yet, even though at a share price in 20 cents, with 138.2 million shares on issue, this company has a market cap of 27.7 million. But don't be fooled by that because you have to take into account the debt. So remember the debt was about 19 million, which means the enterprise value of this company is around about 46 million or so, which means even if you look at the valuation metrics like EV to free cash flow or EV to EBITDA, they are fairly low. So EV to free cash flow 5.5 and EV to EBITDA about 2.7. And that is probably the low of my value threshold. So typically when I look at EV to free cash flow, anything between about 6 and 10 might be screaming really good value. If it gets below 6, that might be screaming really good value, but what's going on? Why is the valuation of a company at really low levels? So there might be something else to play here. And I think what's playing out here is the debt is probably a little bit too high than what the market wants. And even though the market, it does look fairly low, even though this company is profitable, even though this company is free cash flow and operating cash flow positive, the market just doesn't like this company right now. That could change fairly quickly, but right now the market just doesn't like Dynamic Group Holdings. So there could be some good value here, but why is the market not interested in this company? That's a big question when it comes to Dynamic Group Holdings, and I just don't have the answer. There's a lot of possibilities, a lot of theories, a lot of ideas I have, but I have no idea why at this point in time the market is just not interested in this company. That is all I have for this two small caps to buy question mark part 3. Have a look at my other two parts. 4 companies I do like a little bit, some more than others. Now in this video here, both companies I don't own. And I really enjoy doing a little bit of research on Cosol because I want to do more research because that company does look interesting or intriguing. Now, when it comes to Dynamic Group Holdings, for some reason, the market just does not care about that company right now, even though it does look possibly cheap at these levels. So if you have any questions about either of these companies, maybe you're a shareholder of one of these companies and you'd like to add something more to this video, leave those thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.